One of the challenges of factor investing is that these factors, while maybe we have a long journey, that journey is going to include factors outperforming, underperforming. If factors start to go in and out of favor, wow, maybe they worked for the past 20 years, but are they going to work for the next 20? Do I have the conviction to stay with that volatility? Well, the industry has an answer for you.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world. My guest today is Mr. John Lunt, the president and founder of Lunt Capital Management. John co-created the methodologies for more than 10 index strategies maintained by the S&P Dow Jones Indices and NASDAQ Global Indices. From 2001 to 2014, he served on the board of Utah Retirement Systems. From 2004 and 2007, he was also its president. John was a recent member of the investment committee for the $10 billion plus Utah Educational Savings Plan. He also formerly worked on the Washington, D.C. staff of U.S. Senator Robert Bennett. John graduated magna cum laude with the university honors from Brigham Young University with a degree in economics. He later received his MBA in finance and international business from New York University. Hello, John, and welcome to Tao of Chao.
Philip, thank you. It's great to be with you.
Today, we're going to talk about one of our favorite subjects. I know it's one of your favorite subjects, but it's happened to be mine as well. It's about, factor investing. And you and many other quantitative investors and managers have created a significant amount of factor-based investment vehicles, especially in the exchange-traded fund area. Last 15, 20 years has just tremendous growth. Is it because of indexing has significantly helped to popularize this?
Significantly helped. There's now the ability to access factors and make factors investable in a way that, as you noted, rewind 15 years, you couldn't access it in the same way. It was really institutional investors identifying certain factors, but really for the rest of the investment community, it really has been the growth of indexing that's enabled the access to factors that they're now investable.
And you credit that because of, is it technology, or is there any one thing that made this more ability to do the things?
Yeah, I think it's certainly technology that's been a significant driver of this, but it's also the exchange traded fund. In my mind, that it's kind of the confluence of both the technology and the product that's been able to give access to factor investing, that's really brought it to the masses. It's really, in my mind, it's one of the great innovations that's happened in investing, over the course of my career is access to different strategies and factors.
Let's step all the way back, and just for clarification for our audience and for our conversation, John, if you can give us as simple a definition as you can, what is a factor? How do we think about what a factor, what is, or what it means?
Stocks have characteristics and attributes that can be calculated and tracked, and so these quantifiable attributes are what we call factors. Where we can look at the behavior or reflect the fundamentals of an investment. We can categorize it, we can define it, and then we can track it for a particular stock, and then we can group together stocks that have that particular characteristic or attribute. That's what we would call a factor. An example being stocks that have an attribute of or a characteristic of value, where maybe they have an attractive low price to earnings ratio. We group together stocks that have that attribute, and we'd call them maybe a basket of value stocks. Would be an example, but a factor is simply a quantifiable attribute or characteristic of a stock or a company.
So it's like a unique quality that you are
Correct.
trying to group together that to emphasize that
Correct.
particular quality, right? And that will be a factor,
A factor.
right? And these factors have proven one way or another have enough attributes that have made a difference in risk and or return over time. And that's why we're interested in it, I think.
That's exactly right. Um, this becomes a way where we can look at these different attributes and characteristics and say that's going to potentially improve the risk return profile of our investment portfolio by bringing those attributes in to our asset allocation or our portfolio over time.
So a lot of investors have thought of, index investing as we talk about index investing, and as basically as investing in securities that tracks an index.
Right.
Index as some organization decided this is the way to go, and they're everywhere. I mean, there are so many indexes now. But in reality, most don't think about indexing or indexes and how they're constructed. They don't think about how it's constructed or how each security is weighted. So in fact, indexing is a sort of an implicit factor investing, I think. Correct me if I'm wrong. What's your thought about indexing and factors?
Yeah, it is because really indexing is a methodology. It's embracing a methodology and a set of rules. And I agree with you. People think about indexing, and their mind immediately goes to this term passive, and we're going to hold the S&P 500 by its size, by market capitalization. Really, though, it's a methodology. It's a set of rules, and we even look at that. And there's some very there's some very explicit factor exposures across any index. It can be very, very diverse. It can be very, very simple, but any index really is going. If you strip it down, it's going to have some type of factor bias or exposure.
So before we go deeper, I must say about some 30 years ago when I first started in my career, in the investment management career, I learned about Pharma French three-factor model. So I learned about how they have tried, it's through this idea of, what are those things, I don't want to use factor, what are those attributes that created positive return by managers? We're always trying to figure out how come some people are more successful in it than others. And so they identified three factors. I mean, the one factor we all know is the market itself. I mean, if you don't take any risk, you're not going to make any return. You're not going to have any losses, and all those type of things. But they also identified two others. One is size, so large, mid, small, what have you, matters in terms of return, and value factor. We use it all the time now. It's no longer sort of a novel thing. But in fact, earlier in 1976, Stephen Ross came up with this idea of arbitrage pricing theory. I know it's technical, but really what he was trying to show is there are multi-factor approach to understanding stock return, which is another way of saying how does a manager add or subtracted value. And the idea was, let's find those little secrets and then we can do it too, right? I mean, that's the idea. When we find an inefficiency, and I'm questioning if factor is really inefficiency identifier, but in markets, it's what they call arbitrageable situation, where it's inefficient market. I have more information, or I know something that the other ones don't know, or it's not efficient, and I'm able to arbitrage, meaning I will buy here and sell there, and I can make the spread or make money. So factors in a way was suggesting that as well. So sorry, a lot of questions in there.
Oh, I love it. Philip, I love how you have described kind of the history of factor investing, because I think that the way when we start to talk about factor investing, it starts from a context of what are we investing different from the market? So your benchmark, your context, then that beginning point is the market capitalization weighted market, index. And then anything that we do that diverges from that market cap weighted index, now becomes the potential to be a factor, something that can add or detract from performance relative to the market. And the way that we then see that as a factor is going to be something for a company or a stock where we can measure that a certain attribute or a characteristic and identify it, isolate it, measure it. And that's why certain factors, there's been a lot of kind of the industry and academic research has coalesced around a handful of certain factors that have been persistent and they're measurable, and we can go back and identify them over time. But there's certainly a lot of exciting research and debate around what are other factors that might be might be different from those very, very traditional focused on factors.
So if I may say it back to you, make sure I'm hearing you, is that if we don't deviate from an index, we cannot add any value, and we're just basically replicating.
Correct.
The question is, how do we deviate from it? But when we start deviating from it, then the question is that the right index for us to measure ourselves with, right?
Correct.
Help me out a little bit. How can we be true to saying, here is an index, or S&P 500, and I am either active manager or a factor enthusiast, and I want to be able to outperform over time and still stay within that universe? How do you do that?
Yeah, I think you've highlighted a really important point, which is to really compare. We have to be working from the same universe.
Yes.
It can't be apples and oranges. It needs to be apples and apples. And that's why, we think factor investing in the U.S. large cap space, it's so robust to look at factor investing there because we can work from the same universe, effectively those 500 stocks. So that if that becomes the benchmark, the universe, then identifying certain, putting on a factor lens and identifying components of that universe, we think becomes a better apples and apples comparison, for us to look at. Because you're right, so much of investing is a mismatch of the different investments and maybe their benchmark or different investments to each other that really are looking at different attributes.
Right.
Or different characteristics.
I like to define the sandbox first, so you cannot go and grab the sand from another box, so to speak. Right?
I love it.
Talk just for definition purposes. Please help us. I even think definition is not clear when we start getting into factors. So size, I think we understand. Size meaning large, mid, small, and there's some gradation of where the fuzzy but close enough division line where large become mid becomes small. But momentum, can you talk a little bit about, we all understand the word momentum, but how is that factor defined?
Yeah, and that highlights, an interesting, another interesting point is that while we may gravitate to factors like momentum or low volatility or value or quality, there still is very reasonable debate about the best definitions, of those. But taking momentum as an example, it would be looking at the past performance, and high momentum again would be looking at the best performance over some trailing period of time. Some might be looking back and saying, let's look at the trailing 12 months performance of, say, those S&P 500 names and rank them by that performance, taking a certain number, the top 50 or the top 100, and saying that's a basket of high momentum stocks. Others may prefer and say it's not a trailing 12 month, it's some combination of trailing 3 and 6 and 9 and 12. And so again, you might have different flavors of how people define something as momentum, but at its core, momentum and volatility are going to be the least controversial.
Okay.
in their definitions, because it's really just going to be looking at the the movement of stock. There's not going to be any kind of debate about some type of fundamental factor. It's really going to be looking at the behavior of the stock price itself.
So let me ask you a different question. I think with the extraordinary return, just extraordinary return of the S&P 500,
Yeah.
you go back 5, 10, 15, I don't care, a reasonable period of time, and it outperforms just about everything else,
Yes.
just about. Historically, it's a truism that for every unit of risk you take, you expect that certain amount of return. Otherwise, you wouldn't take any risk, right? I mean, it has to be appropriate. And in theory, the more risk you take, the more return over time you should have. That has not necessarily always happened to be true when you look at the S&P 500. Am I thinking correctly, or am I just remembering the good times and not remembering the bad times?
I agree with your point that inherent in anything that we do is this some connection and correlation between risk and return.
Yeah.
That underlies all that we do, and part of again factor investing is saying is not disagreeing with that, but instead saying, are there ways that we can focus on certain attributes that improve our that risk return profile over time? That's why you end up with such a focus on certain factors. Is that persistence over time of those attributes improving that risk return profile relative to the S&P 500.
So when you are talking about factors, when you talk about testing and you're talking about over time, none of those factors testing is static. I mean, it's constantly testing, right?
Correct.
So
Correct.
if I want to go into a low volatility factor, meaning that regardless, I'm looking back 3 months, 6 months, 9 months, or an annual basis, whatever decision the manager have created or made, is constantly reviewing those factors and say, okay, as of the last following 3 months, have they still be the lowest volatility?
Right. Right.
And the theory is that if they were low, they will remain low. So in many ways, we're looking backwards all the time to go
all
forward.
the time.
All
Yeah,
the time.
all the
Even
time.
though we have learned going backwards to go forward often does not work.
Correct.
But does it work in the very long run? Does it work looking backwards to go forward in the long run with conviction, with discipline? Does it really work? Or we have to be more supple and more dynamic and more learn as we go and making dynamic changes? Which one is it, or is that a decision?
I love the point, because we have to try to honestly look at market structure and say how does market structure change over time, and even the investability of certain factors. How does that change, factor investing over time? But the premise of factor investing has been that we can identify some of these attributes that have been persistent, over 10 and 15 and 20 years that we've seen, we've seen this outperformance, and that they're explainable behaviorally, that they make sense, that there's that factor persisting over time. I think what you're pointing to is something that we agree with, which is there are times that maybe that factor gets crowded. And when we talk about long-term outperformance of a particular factor, whether it's low volatility or momentum or quality or value, it doesn't outperform consistently every month, every quarter, every year. Those factors go in and out of favor in that journey, that long journey to outperformance. Mm-hmm. Part of that to us is explainable, that there are times that maybe those factors get crowded, and the market crowds into those factors, and then maybe there's a season where the factor underperforms, but still over time you see the persistence and long outperformance of a particular factor, again explained through kind of investment behavior.
You're pointing out something that I'm going to sort of, let's tease it out a little bit more, John, because I'm going to leave something in a little bit to ask you about quality. I think this is more controversial than momentum.
Yeah.
And then ultimately more controversial is ESG factors. We'll leave that to the end, perhaps. Right. When you look at a factor, you got saying volatility is a factor. I'm just using that example.
Right.
But volatility is a factor. There's a whole spectrum of volatility or a gradation of volatility. Very low, I don't care, 3 months, 9 months, however defined, and very high, 3 months, 9 months, whatever, however you define. And there's everything in between.
Right.
So when low vol, let's say right now, this very moment, everybody's a little bit worried about interest rate, inflation. And because I'm worried, I say, well, maybe I should take risk off the table. And I say, well, not only I take risk off the table, I don't really want to get away from stocks because I know in the long run, stocks going to do me just well. So maybe I should just all go to lower vol. I mean, if something hits the fan, at least a little softer. Right? I'm just thinking out loud with you. Yeah. So if a lot of people think like what I just said, they will crowd into low vol.
Right.
So the low vol, by that definition, may become higher vol than the low vol because there's too many people going in there and create more volatility because we're in and out and all that. And the high vol may be becoming a little lower vol.
Yeah.
So how do you think about really every one factor is not a single end of a discussion, but it's a continuum or even two ends of a discussion. How do you think about that, John?
Yeah, we love to think about a factor holistically. We understand why the investing community and academia would focus on the low volatility factor because we believe that there is going to be some persistent outperformance over a 20-year period. But when you look at volatility holistically, we believe when we get into more distinct and discrete timeframes, monthly, quarterly, even annually, we start to see this dispersion within the factor itself. And to your point, not just looking at the traditional factor, but actually looking at its opposite. And it doesn't always, it's not always true. But let's just use a general example. Continuing with your example, we often see periods when low volatility is not performing well, that its opposite side, higher volatility, might be performing well. But people typically are only looking at one side of that factor, the low volatility side, and ignoring, the non-traditional opposite side of high volatility. And we think that if you holistically look at factors, that the part that people ignore can be very interesting at certain seasons, certain periods of time. And that's what gets us excited about factor investing and thinking about it a little differently than just that traditional factor.
So from my sort of a lay person way of looking at factors, because you're the expert, so I want to say it this way. You, in a way, as a value investor, you are finding values without making judgment as to which end of a factor is more accurate or better. Right. Yeah, so let me just continue that to tell me if I'm thinking correctly. Going to this lower vol group, that higher vol group becomes more value. When I say value, meaning that there's less people there, that has a value, almost a value tilt not a traditional value, but
in a factor value.
Right. So by actually allocating there, may give you a surprise reward.
Correct.
Almost like a contrarian value-oriented idea. Is that true?
Yeah. And it also, the traditional approach to factor investing requires, people to plant a flag and say, okay, I'm a value investor, even when value is out of favor and value is not performing well. I'm a low volatility investor, even if everybody else is too. And we think looking holistically, both sides of a factor, allows us to be more agnostic and more objective to say we can adapt as these factors go in and out of favor within markets, even if we believe and embrace that long term we like traditional factors. Over the 10 and 15 and 20-year periods, we think in that journey, looking holistically at the factor, there's going to be times you don't want to own it, the traditional factor, and you want to own its opposite side. That's where the factor value is, so to speak.
You and I think we touch on this in the sense that any of these investments, and any time in order to realize the benefit of factors, whatever the factors are, it takes time.
Yes.
I mean, it's not something we're darting in this factor and darting out this factor and going to another factor and so on. And diversifying among factors may not give you the true factor advantage, because if you have all the factors, then you may as well just buy.
Yeah, you just blended them together.
So how does one think about how many factors is enough? It's a silly question, but there are so many factors, right? I mean, you have at least name 5 or 6 factors. Are there factors that cancel each other out sometimes? Are there factors that enhance each other sometimes? And how do we know what the sometime is, and how do we know that sometimes not?
Yeah, it's there's not a, at least from my view, there's not a perfect answer to your question.
Oh, I'm disappointed, John. There's no perfect answer.
But I think it does highlight some interesting things when we actually take the tools of factors and say, how are we going to use the tool here? What we think, if we're going to look at factors and not just blend factors, but actually say, I'm going to express an opinion, I'm going to be not just kind of be very connected to the benchmark and hug the benchmark, but instead express an opinion. We need to find factors that have dispersion across them. Because if we just blend factors together, or we just focus on factors that are behaving the same way, then there's really no advantage to either rotating factors, or focusing on, specific factors at a point in time. And so the way we want to think about factors is, what factor groups can we bring together in our opportunity set where we're going to have the most dispersion, that we're going to have the most instances in markets where there might be something, that is potentially in favor. But again, it goes back to this idea of creating opportunity sets of factors that don't behave the same way. They may be correlated, but then we look at the magnitude and difference in performance of those factors. That to us becomes such a critical component to design when looking at different factor strategies, is identifying different factors that might have significant dispersion. That's why, Philip, we think in terms of high and low side of these factors, because that's where we see the biggest dispersion. Sometimes it's not saying, we're seeing big dispersion between the value factor and the quality factor. It's often, in our view, better to say I'm seeing dispersion between high quality and low quality.
So we're going to do a real quick round of identifying some of the most popular or most well-known factors. There are a lot of factors that we just can't quantify, or it's not investable. Right. But anyways, we talked about value. Can you be very clear on what value means?
Yeah. And again, being very clear, each kind of index provider or maybe investment firm would have their own view of that, but probably it's looking at things like price to earnings and price to book, price to sales, some combination of those metrics would be often what would define value, the value factor.
And then compared to the growth, which is the other side.
Correct.
Growth is really go, right, in theory.
Right.
Where all the exact opposite metric of higher earnings and higher, all revenue and all promise of the tomorrow.
Correct.
So technology tend to be on that side, whereas more traditional goods and services on this side. I'm making a very
Right.
general discussion. And then we talked about momentum.
Yes.
And you're saying basically going backwards to see how it has continued to do well, if it has done well. So
Correct.
if it did well today is more likely to do well tomorrow. That kind of a
Right.
momentum.
Correct.
And in your way of thinking is the other end is if they didn't do well, they may end up doing well. So let's not
Exactly.
discount that side
Yeah.
either,
Yep. This mean reversion that can happen.
right? Right. So in many ways, some value discussion also bleeds into quality.
It is.
Can you help us to understand how we think about quality and how we think about quality somewhat differently than value, even though there may be some?
Yeah. Because I think that you might say they're certainly, maybe they're siblings, but they're not twins, or they're
Yeah,
cousins. There's a lot of similarity that you'd see there. But what quality is attempting to do, and this is maybe where you see, different financial institutions might have different definitions, but looking at things like return on equity, accruals ratios, ways to get at earnings, and start to see, can we differentiate between those earnings. There's firms that I think have done interesting things with free cash flow yield. Different ways to say, it's not just looking at your earnings, but are there other ways for us to dissect them, or categorize them in a way that is repeatable, but to be able to favor one or the other. Again, maybe it's financial leverage that gets introduced, as a way to look at a company, in addition to just things like return on equity and an accruals ratio or free cash flow yield. But you can certainly see some similarities with value, but there's been, particularly when there was such a significant season of underperformance of pure value, there was a tremendous effort to say, well, let's look at quality. Let's expand that view to not just looking at things that are undervalued, but let's look at the financial profile of a company and see if we can identify higher quality, of the fundamentals of that company.
so you can actually have a lot of not a lot, there are crossover between low volatility, value, quality,
Quality,
that kind
yeah,
of thing. And then
correct,
on the other side, growth and
correct.
momentum, we have a lot of
A lot of
similarity,
overlap, right?
right? And then let me just throw in ESG, which I was told that Larry Fink no longer used that term. But let's talk about E being environmental, sustainability, and governance. And governance has something to do with quality. I assume that you want a company that's governed well and
Right,
is think about their employees. All the things that
right,
related to governance.
right,
So there are many lenses, right, that you can look
correct,
at a company, and it's almost a proprietary weighting of what sub factors within that factor you feel as a manager more important
right,
over a period of time. Is that a
right.
fair way of thinking
That's
about
a great way to think about it. That it's important to understand the definitions that are being used to measure, certain factors. And as you know, the further we get away from maybe these four or five very uh, traditional factors, so to speak, the more difference and we're going to see in people's definition. And again, their proprietary view of, this is what matters more or matters less. Once we kind of diverge away from some of those very traditional factors.
So you know this very well. The Biebauer study, 1990s, twice, one and two. Singer Biebauer is the second one. To talk about the determinants of return is give very little credit to skill.
Right.
Basically, say, look, you're gonna find that if you're in the right asset classes, so maybe right factors, right, the right time through diversification, blah blah blah, is that determining what you should have in your portfolio is the biggest driver to the outcome. If you have the
Right.
wrong one, you have a terrible return. If you have a right one, you have a wonderful return. And that skill is very little, and luck or unexplainable things are others. So when we think about that framework, which was used years ago and remained to be true, in our practice we talk about asset allocation being the single most important.
Right.
But easier said than done. Most important. Then what's the next sentence, right?
Yeah.
Knowing what that really means and how factors can contribute once you have decided in broad sense how much should be in stocks, how much should be in bonds, how much international, and so on and so forth. Then use factors to inform us within each sliver what factors will contribute. So it gets more and more difficult to make those decisions because each decision
Right.
is meaningful in the portfolio behavior, both from a volatility and risk standpoint, as well as reward in terms of return standpoint. How should an investor or folks like us who manage portfolios think about allocating to factors? What are some of the 1, 2, 3 rules that you say, okay, if I'm doing this, this is this, and this? Because it sounds wonderful, but on the other hand, you peel away like an onion. There are more complexity as you go through because it's, number one, it gets less and less well defined as you go down.
Correct. Correct.
And I don't know if most investors are going to go in and say, okay, your value is different than his and hers.
And I prefer this definition to that definition.
How would I know which I prefer? So talk to us a little bit about how you will slay this dragon in some way. How do you do this?
Yeah. I'll walk you through how we think about it because I think you've just articulated the challenge. One of the challenges of factor investing is that these factors, while maybe we have a long journey or we have outperformance over a long period of time, that journey is going to include factors outperforming, underperforming, and it's very easy in a single factor sense to then say, oh, wow, this factor is not going to work anymore, and I'm going to abandon it. Exactly, maybe at the moment we shouldn't abandon the factor. And so
that never happened to me, though, John.
No, I was talking about others, certainly not you.
Okay, thank you. I just want to be clear. We have no behavior biases in this.
None of us do on this call. But I think that highlights one of the challenges for a financial advisor or an investment professional, let alone an individual investor, is if factors start to go in and out of favor. Wow, maybe they worked for the past 20 years, but are they going to work for the next 20? Do I have the conviction to stay with that volatility? Well, the industry has an answer for you. And the industry's answer is, well, Philip, just take all these factors and we'll just blend them together. And then you end up with something that maybe is just a watered down version of the market. And so the way that we came at this is to say we really want to express an opinion. We think that the journey to that outperformance is going to include looking different from that benchmark, and then looking at an opportunity set within, for example, large cap within the S&P 500, and saying let's look at multiple factors, but let's look at both sides of that factor. Mm-hmm. Where we see the most dispersion. And because we have this behavioral bias and we're all susceptible to it, we need to come up with some rules that will protect you from me, from my behavioral biases.
Yeah.
And then look and say, if we see certain trends in particular factors, can we own those factors when they're having a good trend? And then when the trend changes, can we move to other trends? That's what we intend to do. But there's trade-offs there. What that means is that when factors aren't trending, that type of an approach to factor investing can be susceptible to head fakes or whipsaws, when those factors, are trend seeking.
Noise and there's no trend.
Right. And so there's no perfect way to do it, but a preferred way that we think is sustainable and we just have conviction around is looking at factors, a universe of factors, both sides of factors where we see dispersion, using rules to then adapt to their trends, changing trends, over time, being willing to look different and be opinionated. We think that's a recipe ultimately to having the potential to capture some outperformance. But what that requires, when we talked about it a little earlier, is that you might be out of favor, you might be underperforming, the benchmark for a certain period of time. Does the investor have the conviction to allow that process to do what it's designed to do?
That's always the $64 question: is the conviction. Yeah. Can you stay with it? Can you stick with it?
Can you live through it? It's great to have things that theoretically, look great over a decade, but can you actually live through how its normal characteristics?
So it sounds like, if I may say, that factor investing has proven itself to be a very worthwhile way to be considered as part of investing. And if we are passive investors, quote unquote, in indexes, we are already participating in factor investing. It's just that we don't call it that. And the question is, how do we improve on either from a risk standpoint or a return or both? And it sounds like unidirectional, we may be disappointed and we don't have the patience if we just do unidirectional. Okay, always this, and then there are going to be times that do well and there are times not. That perhaps we should be thinking about each factor really is comprised of at least two sub-factors. Yes. So volatility, there's the low vol, and then there's the other vol.
Correct.
And it's not always low vol going to do well, but volatility by itself as a factor is more important than, say, only low or not low. That type of idea.
Yeah, holistically, we love that.
And then I think what I take away from this is also thinking that it's really challenging, even for professionals, to think about what are the relevant factors at any period of time.
Correct.
And to fight against behavioral biases by concentrating on any one or groups of factors. If you have too many factors, then you diluted away the advantages factors provide you. But if you don't have the right factors, or you stay with the factors, but you don't have the time horizon that you thought you had, you're going to hurt yourself as well. It's not just a single thing, but it's a continuum of things. That, if I'm saying it.
I love that. I think that's a wonderful summary of how we think about this wonderful world of factor investing. It's challenging, but we see that gives it a really fertile ground for opportunity. There we like the fact, Philip, that there's not all this agreement about how to look at factors and how to define factors and which factors should we use. That speaks to opportunity, and there's going to be new ground that's going to be broken in looking at different factors. So we think this is a really fertile ground to continue to explore and use as a tool as part of that investment process.
I have a lot of clarity on some areas, and I'm still confused in others. So maybe we'll go to a part 2 when I
Wonderful.
figure out how to,
I love it.
But John, thank you so much. I really appreciate it. I hope the audience can also hear what we are trying to suggest are both the benefits and the challenges that they should be thinking about as they look into factor investing, which is very much part of what they are doing now. I dare say any one of their portfolios have factors in it that
whether they know it or not.
Exactly. So thank you again, John. Really has been a pleasure learning from you and spending time with you. And thank you for joining me for this episode.
Thank you for your thoughtful comments. I've really enjoyed this conversation.
You can always find more episodes by visiting philipchow.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchow.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.